Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello, and welcome to the Money and Meaning Show. This is a show where we help people uncover what matters most and helps them get their actions and resources in alignment with what matters most. And today, I'm joined by Peter Nakada, Chief Education Officer of Stone Ridge Asset Management. Stone Ridge is known for its work in alternatives, real assets, and long horizon investing, often in areas that don't fit neatly in the traditional 60-40 portfolio. Peter, welcome to the show. Really excited to hear from you today.
Thanks, Jeff. I'm excited to be here as well. And the timing is pretty important here. It's a good time to be talking about things that are not stocks and bonds, given market volatility. And, as a reminder, 2022, we can see stocks and bonds can go down a lot. So I think the timing is right, and I'm excited to chat with you.
Absolutely. Well, before we dig in, let me give you a proper introduction here. So Peter Nakada is the Chief Education Officer at Stone Ridge Asset Management, a $30 billion alternative investment firm that focuses on long-term diversifying sources of risk and return. Stone Ridge has emphasized intellectual honesty in investing, being explicit about trade-offs, uncertainty, and the differences between risk we're paid to take and risk we're not. And we're going to dig into a lot of that today. They're known for their work in real assets, systematic strategies, and reinsurance, and for encouraging investors to think probabilistically rather than through narrative or stories. Especially like today, markets are noisy and emotions run high. So again, Peter, welcome and thanks for being here.
Thank you, Jeff.
Yeah, so let me start. This show is, again, all about helping people create clarity and confidence to understand sort of what matters and then get their actions and resources in alignment with what matters. And something that's really important to us is to be clear about our why and about who we are as people. So I love to just start the show kind of informally, if you don't mind.
Sure.
I'd love to just hear a little bit about you and your path to Stone Ridge. So tell me a little bit about yourself and your path to Stone Ridge.
Yeah, absolutely. Let me take you way back. So I grew up in a steel town in Pennsylvania, back when we still made steel in this country. I studied electrical engineering in college. I worked at Bell Labs for a hot minute and quickly decided I didn't really like being an engineer. So I switched into finance, particularly risk management. It was back in the days when there weren't quants in finance. And so I spent a fair amount of my career teaching banks about the mathematical aspects of credit risk. Along the way, then, I got into a more esoteric thing called catastrophe risk, building simulation models of hurricanes and earthquakes and wildfires. And I was with a firm called Moody's RMS. And that led me to Stone Ridge, where Stone Ridge used the software that we built to manage its reinsurance strategy, which was the very first strategy.
That makes a lot of sense. You had skill set that was really important for what they were building out into this asset class we're going to talk a bit about shortly. So, as I mentioned, the show's about helping people understand what matters and get their actions and resources in alignment with what matters. So tell me a little bit about your why. What gets you excited about the work that you do and how you use your unique gifts in service to your clients?
Absolutely. So what's super important to me is helping people achieve financial security. And I'm not talking about just the super rich. Super rich have a lot. They already have financial security. It's everybody. It's really helping everybody to understand that there are tools out there that they can use to have a more stable financial situation, not just to retirement, but through retirement. And I'm excited about helping to solve those problems that are hard, that people didn't even know you could solve. And lastly, I'm excited about teaching people about them. My title is Chief Education Officer,
Right.
a title
Yeah,
that I
that's
made
a great
up.
title.
But that's what I do. I teach people. I'm really interested in making sure that investors understand the nuts and bolts of what we do.
Very, very helpful. Yeah, and that's really critical when you're dealing with asset classes that maybe a lot of people don't know as much about, which you guys are experts in. So that's a great segue, I think, to Stone Ridge itself. So tell me a little bit about Stone Ridge. Why does it exist as a firm? What problems is the firm trying to solve for investors that you guys felt like weren't being addressed adequately prior to what you guys are working on now for a number of years? But tell me a little bit about Stone Ridge.
Sure. So one of the big problems that we are tackling is the notion that almost everything that people invest in is somehow tied to corporate profits and interest rates. You think about stocks, you think about bonds, many of the things, I would say most of the things that people have access to move around when corporate profits or interest rates move around. And what that does is it means that your portfolio is much riskier than it needs to be. And I mentioned this earlier, 2022 was a great example when stocks and bonds went down. And what we believe is that people would be way better off if they had more alternatives to those kinds of investments. And our goal then is to introduce different sources of return so that the portfolio can truly be diversified. Now, this is not about higher returns necessarily. It's about portfolio resilience.
Gotcha. Well, you used the term alternatives, which is an important term, but it gets used a lot. And I find, depending on who you talk to, sometimes it can mean almost anything, depending on your definition of alternatives. So how do you define alternatives? And, just importantly, what do you think people misunderstand about alternative investments?
Well, first of all, a lot of what people think of as alternatives are not true alternatives to the risk exposures that you're facing, right? Okay. So as I mentioned before, a lot of alternatives, I'll use the classic examples. People think of private equity as an alternative. They think of private credit as an alternative. But those are just stocks and bonds that have different liquidity profiles, right? So you're not really getting an alternative risk premium or exposure. And we think of something that we call true alternatives as opposed to traditional alternatives. And those true alternatives have different drivers of the risks. And I'll give you two examples. Natural disasters. In our reinsurance strategy, the risk driver is hurricanes and earthquakes and other kinds of large natural disasters. Another risk driver that's not related to corporate profits or interest rates, natural gas production. How much natural gas you can get out of the ground is a function of geology and physics. It's not a function of the markets. So diversification only works if these drivers are truly different.
Yeah. Different than just economic cycle risk or interest rate risk, as an example that you mentioned. A lot of the vehicles that are viewed as alternatives may not be quite as good a diversifier against economic cycle risk as a true alternative as you define them. Is that fair?
Exactly right.
Yeah. Okay. Well, as I mentioned before, a lot of the audience for this show are people who are either recently retired or within the next 10 years of retirement. So they're getting ready for this second act. So how do some of these alternative investments, how can they be helpful for that type of investor who is preparing for or early in what could be a long retirement?
What you said at the end is a key point. What could be a long retirement. So with medical advances and lifestyle changes, life expectancy is a lot longer than most people think. So probably the folks listening to this podcast have a life expectancy of about 90. Right? So imagine if you're thinking of retirement when you're 60, you've got a 30-year horizon, which is a really long time, both from the perspective of how you need to finance that retirement, but also the amount of time that you can compound what's left over after you've financed the cash flows that you need. 30 years is a really long time, right? If you think about compounding at 8% for 30 years, that's a 5x multiple of what you start investing, right? So what you need in retirement, therefore, is something that allows you to have that kind of return to compound. But you also want something that manages volatility, because you don't want big drawdowns while you're in retirement. So the old model was, as people moved into retirement, they shifted more and more into bonds, right? The glide path concept, where you might have started at 60-40, but then you start gliding into something that is much more bonds as you go
through. Like the target date fund idea.
Target date fund idea, exactly. Yeah. And the problem with that is that you're giving up the compounding. You're giving up the opportunity to compound growth assets for that 30 years. The new approach is to use true alternatives to diversify that risk away that allow you to preserve that risk premium, but reduce the risk through diversification rather than using bonds and fixed income.
Makes sense. Yep. Well, I know when I started to do my original research on Stone Ridge, y'all had a piece out a few years ago that was really helpful in sort of framing the problem. And the name of the article was Illuminating the Path Forward, Breaking Free from the 60-40 Portfolio. I don't know if you remember that.
Yep.
It's like a white paper, kind of a white paper research that you did.
Yep.
And of course, back then, it was a totally different interest rate environment that we experience today. So today, we have much higher bond yields. So I guess my question is that framework still relevant now that we actually have higher bond yields? And, what still holds or what needs updating, do you think, from that original piece?
Absolutely.
Any thoughts on that?
Yeah, sure. So the structural point that we made in that monograph still holds, which is that the investable universe is much bigger than most people think. And by diversifying away from the things that have corporate profits and interest rates as drivers, stocks and bonds and other things like that, you can improve your portfolio. The thing that needs updating was, when we wrote that, interest rates were at or near zero.
Right.
So it was not only were bonds not a great diversifier, they were a terrible diversifier because you were giving up all your return. So in that paper, we went out on a limb and said, you should have zero fixed income in your portfolio.
Yeah.
And it was out on a limb because it was certainly one of those things that made people sit up and notice, but it was also true. Today, with bond yields higher, we don't think the same thing holds. We think that bonds do have a place, but they have a place alongside true alternatives. So you should use both of these in order to diversify your portfolio. And yet the point still holds that the only free lunch in finance is diversification.
Right.
And if you can find true alternatives, you really maximize that.
Yeah, makes sense. Yeah, I mean, the world does change and you have to adjust your thinking with that. But the major point is having asset classes that are not so tied to economic cycle risk to play defense and more diversification. So Yeah, so I'd love to focus on one of those alternatives in the balance of our discussion, because I think it's one that I'm finding potentially the most helpful from a portfolio construction standpoint. And it's also the one that seems a little complicated to the typical retail investor. It may not be, but perception may be there. So you guys have deep expertise in reinsurance.
Yep.
And so for listeners without an investment background, can you explain sort of in plain English what reinsurance is and why it even exists in the first place?
Absolutely. So let me start with something that everybody on this call will be familiar with, and that's homeowners insurance, right? So you own a home, you got a mortgage on that home, you have to have homeowners insurance. So you go to someone like Allstate and you pay them a premium and they pay out a claim if your house burns down or your pipe freezes and bursts, that sort of thing. Now, ordinarily, Allstate can handle the losses that come from that because they're super diversified across the country. The thing that Allstate can't handle by itself, though, is the possibility that a Cat 5 hurricane comes through Miami and causes $200 billion worth of insured loss, right? That could actually threaten the solvency of Allstate. So what does Allstate do? Allstate turns to a reinsurer, someone like Swiss Re or Munich Re, and buys insurance themselves. So reinsurance is insurance for insurance companies against these major natural disasters. Okay. Now, people can invest directly in that reinsurance. And it's very much the same as what Allstate does. The Swiss Re gathers premiums for providing the reinsurance, and they pay out claims when there are big natural disasters. Okay. So intuitively, people know that they're paying out more for their homeowners policy than they're likely to get back. And they're happy to do that because the insurance company's taking their risk away. Reinsurance is the same thing. You're gathering the premiums, you pay out the claims. On average, over time, you're earning a risk premium. And the beauty of that, coming back to the first thing we started talking about, is both on the gathering the premium side and the paying out claim side, neither one has anything to do with corporate profits or interest rates. So it is kind of the poster child for a true alternative.
Gotcha. Yeah, that makes great sense. And so there's a couple ways to capture this premium. I mean, there's catastrophe bonds and quota shares. Mm-hmm. And so I'd love for you to explain the difference in those two vehicles or ways to capture it. And I'm curious, from a diversification standpoint, is one inherently better than the other, or do they play different roles? So educate us a little bit on cat bonds and quota shares.
So think about cat bonds. That's a short for catastrophe bonds. People don't like to say the word catastrophe too often. Cats sound cuter and furry.
Better. Yeah.
So cat bonds, think of them as like the debt-like instrument, right? They resemble high-yield bonds in that they pay a coupon, they're liquid, they're tradable, and they tend to be lower risk and have lower downside than the equity-like version, which is called quota shares. So think about it like a debt and an equity version of reinsurance.
I see.
Quota shares have higher return potential, but also higher risk. And so the folks that want to consider that are folks that might have a little more risk tolerance and a slightly longer time horizon because they are less liquid. But importantly, these have the same underlying factors, which are gathering premiums and you're paying out claims. They just have different roles for people with different risk preferences and different liquidity preferences.
Gotcha. Makes sense. So, yeah, so we know as investors that we expect to earn a return for taking a risk. And I know you've already alluded to some of the reason we expect a premium in some of these alternatives. But what are the specific risks that investors are being compensated for in reinsurance in particular? And what risks should they be aware of? So if we're allocating some money to a product that's invested in quota shares, as an example, what are the risks that they're accepting that they're being compensated for?
That's super important. because you want to be eyes open about the risks before you get into an investment. And at the very highest level, the risks that you're exposed to are natural disasters, natural disaster risk. And I can give you what they call the big six perils, and they are in order of size: U.S. hurricane, then U.S. earthquake, then U.S. wildfire, then Europe windstorm, and that's, people might know, the first three everybody knows about. Europe windstorm is an interesting one. It's like a mild hurricane that can cover multiple countries. So it's like a huge mild hurricane. So you wouldn't think of like 150, 160 mile an hour winds. You might think of like 100, 110 mile an hour winds, but covering multiple countries. So Europe windstorm is number 4. Number 5 is Japan typhoon, which is like a hurricane in Japan. And number 6 is Japan earthquake. So those are the 6 things that you need to be most concerned about in reinsurance. It's not that natural hazards don't happen in other parts of the world. It's just that they aren't as populated or insured. Those are the places. And in fact, you think about it, why is U.S. hurricane the biggest risk? Well, it was a terrible idea for us to build $1 trillion worth of high value property on the coast in a peninsula sticking out where all the hurricanes come, called Florida. But now that we have it, we've got to insure it. And those are the big 6 perils.
Yeah, it has to do with the economic impact of the peril.
Exactly.
Yeah.
Exactly. You need 2 things to happen. You need a big hazard, like a big hurricane, and you need it to hit a very populated, high value, lots of insurance place. 2 important things to note from an investor's perspective, and that is, this is the eyes open part. Number 1, losses can cluster over time, right? You could have several bad years in a row, which we did have from 2017 to 2021. There were 3 bad years in there. And that's a reality. And then the second thing, and this is a little bit of finance speak, but I'll explain what I'm talking about. The finance speak for this is that it's a negatively skewed risk. What does that mean? That means that in normal times, you just gather premiums. So there are steady gains, and then you have an occasional large loss when you give back some of those gains. And the way to think about this is, we like to say, it goes up when it doesn't go down.
Yeah. Yeah. So, yeah, and you've taught me, as I've read and watched you speak, about 2 terms that seem counterintuitive in a way to me, but we hear about hard and soft markets when we talk about insurance. So after large losses, again, pricing adjusts, underwriting tightens, and therefore premium income might be higher. And we think about, over long periods of time, the asset class being self-correcting because of that. So I guess talk to us a little bit about this soft market idea, and is the asset class really self-correcting because of it? Right.
So just by way of clarifying the terms, hard does not mean difficult. Hard is like the opposite of squishy, like soft. Right. Okay. Hard means that the premiums are strong.
Oh, solid. Yeah.
Solid. Exactly. So I think the industry maybe could have had better words for that, but we're kind of stuck with it. So think of hard not as difficult, but as firm. And what happens in the reinsurance industry is that you're going along fine, and then you have a big loss. You have a big hurricane that causes the money to the capital to need to be paid out from the reinsurance companies.
Like 19 through 21.
Exactly.
Okay.
Exactly. And so then the capital leaves, and in order to attract capital And also to pay for those losses for their shareholders, reinsurers raise the prices. Okay? And this is a really important aspect of reinsurance. They're not regulated. They can set the price wherever they want and need to in order to maintain profitability across the cycle. So quite frequently, after a big loss, they then raise premium rates.
And those are premiums to the direct underwriters.
Exactly right.
So these are the insurance companies that are paying the premium to the reinsurer.
This is insurance companies paying premiums to the reinsurers.
Right.
Right. So the reinsurers get to charge whatever. The primary insurers are more regulated by the state insurance regulators. Reinsurers can charge whatever they need to.
Right.
So just a good way to think about this will hit close to home for some listeners. If you've ever crashed your car, what happens to your insurance premiums?
Goes up.
They go up, right? So think of like a hurricane as the industry crashing its car. Premiums go up, and that ushers in what they call a hard market. Premiums go up and underwriting tightens as well. So you're actually getting paid more for taking less risk, okay? Then the reinsurers, if there are quiet years, they make a lot of money during that time. And after they've made money for a few years, then the pricing starts normalizing again. It starts coming back down and the prices fall, ushering in a more soft market, right? And this is a key thing for investors to remember, is that in order to really get the value of this asset class, you need to stay invested through the cycle.
Yeah.
Okay.
Yeah. Really important. Yeah. So, I mean, patience really matters here. I mean, we talk all the time in portfolio construction and educating clients about don't get wrapped up into what I call line item risk, where you're looking at every line of the portfolio.
Yeah.
You got to look at the total portfolio. So you do have to have patience here. So is it fair to say that reinsurance only works for investors who have a really long time horizon? Is that a fair statement?
Yeah, I would say when you say really long, it's not, I would say that the typical cycle is about 5 to 6 years.
Okay.
So I guess that's long-ish.
Yeah.
I would call it more medium than really long. So I would use that as a benchmark.
Yeah, that makes sense. And you've got to understand, the cyclicality of well, and it's really not cyclical because it's unknowable. I mean, that's the whole point. But when you're in a hard market, you are collecting more premium.
That's right.
Yeah,
exactly.
And you want to stick around for that.
Exactly right.
Yeah.
The flip side of that, though, is when you get into a soft market, it doesn't mean that you should be redeeming during that time, right? Because you're still, even in a soft market, you're still getting paid really well for the risk that you're taking. And you just don't know when the cycle turns. And you want to make sure that you're capturing the whole cycle rather than trying to time your way into it.
Yeah. Yeah, we talked about this a little bit, but let me just give you a chance to talk about it in particular as we talk about reinsurance. But why might reinsurance be particularly helpful for that retirement income portfolio relative to just a traditional portfolio or a normal accumulation portfolio that people think about?
Sure. So 2 main reasons. One is reinsurance is very cash flowing. So in a cat bond strategy, you typically get quarterly distributions of the profits for each year. Okay. And in quota shares, you typically get annual distributions of all the profits. So from a retirement income perspective, it's very nice to have something that is throwing off so much cash. Thing number one. And then thing number 2 comes back to what we started talking about, which is because this is a true alternative and very common sense, unrelated to stocks and bonds, it really helps reduce the risk for retirees. Gotcha. Now, importantly, I want to say one thing, though, is while it does throw off income, this is not guaranteed income. You can't take that to the bank. Large events can interrupt that income. but it is cash flowing and super unrelated to stocks and bonds.
Yeah. Yeah. Valuable, and both characteristics are good characteristics for the retirement income investor, I guess. So,
Yep.
yeah. So while none of us can forecast returns with any real precision, we do need to as we build portfolios and we make assumptions about retirement income planning, we do need to come up with some reasonable assumptions for expected returns in all asset classes, not just reinsurance or others. So how might we think about an expected reasonable return for reinsurance, quota shares, or cat bonds, whichever you prefer, say relative to treasuries as a benchmark? So what is a reasonable expectation for the asset class?
Yeah. So one of the things that we like to do is to go back to first principles to think about these kinds of things. Because when you're talking about these capital markets expectations, you're looking across a number of cycles into the future. So one version of it is like, you don't really know. But if you go back to first principles on this, remember that with quota shares, that's like the equity version of reinsurance. You're investing right alongside the reinsurers in the business that they're doing. They are pricing this business to earn an attractive return for their shareholders. So we think of the returns on the quota share side of things to be very much akin to equity returns. And when we think about equity capital markets expectations across the cycle, we think of treasuries plus 4 to 6%.
Okay.
If you look over a long time horizon.
Right.
Cat bonds are more like debt. And so we think of that as a bit behind the 4 to 6%, call it 2 to 4%. And we use those when we think about asset allocation. So we think that that's a totally reasonable thing to think about. Now, a caveat there doesn't mean that it's always going to be between treasuries 4 to 6%. That's right. Just the long run expectation that we think. There's going to be a lot of variability around that.
Yeah. Well, like all asset classes for that.
Exactly.
Yeah. Yeah. Okay. Well, from a portfolio construction standpoint, or as we're building a diversified portfolio, I mean, how much would you need in reinsurance, as an example, or this asset class, to make a difference from either return or a diversification standpoint? I have to assume there's some level where if it's that small, you might as well not even bother. So what would be a reasonable minimum allocation to even make a difference in a portfolio, do you think?
Yeah. So over the decade plus that we've been helping investors access this allocation, what's emerged as sort of the lower bound, if you will, is 5%. Okay. Less than 5%, and you're doing all the hard work and you're not moving the needle.
Yeah.
Does that make sense?
That makes perfect sense.
And so, and then on the top end, people generally tend not to allocate much more than 10%, because then you start getting a little bit of concentration risk to that. And it's more optics than anything else. Like the asset allocation optimizer would tell you to do even more, but we see 5 to 10 as really the sweet spot allocation.
Yeah. Well, and there's a behavioral element too. Obviously, with you've got an asset class that doesn't look like anything else.
Exactly.
Investors may forget why they own it.
That's right. Exactly.
If you have too much of it, even though it may be a good thing. So anyway, without getting into specific products, so what are the common ways investors can get allocations or invested in these asset classes? Is it, private investments or interval funds or mutual funds? What are the vehicles that investors get into these categories with?
Yeah, what's nice is that this asset class has been around long enough, back to 1995. It's been around long enough that there are now quite a variety of ways for people to get access to it. Let me start with the most accessible, and that is mutual funds. So for cat bonds, there are daily liquid mutual funds that you can invest in that give you access to cat bonds. For quota shares, I remember I told you those are less liquid.
Right.
Those are available through interval funds. Those are closed-end mutual funds that have limited liquidity. So you can get in daily, but you get out, for example, quarterly.
Yeah.
And then they typically have a fund level gate on that,
Right.
something like 5% or maybe a little more than that.
Right.
So two kinds of mutual funds there. And then there are private vehicles that tend to be even less liquid than that, but also higher octane. So those are more for the folks that are at the higher end of the high net worth spectrum, who are able to invest in private funds and deal with the K1s and the subscription documents and that sort of thing.
Yeah, additional complexity.
Exactly.
Yeah. And much higher minimums as well.
Exactly, higher minimums as well.
If you got to have a lot of capital to get, 5 or 10% could be a lot of, it still requires a lot in terms of the minimums. So what are the most important questions that investors don't ask or should be asking about reinsurance?
So the one that investors really should ask and should do some soul searching before investing has nothing to do with the math of the investment. It has to do with behavioral psychology. It has to do with investor psychology. And that is this asset class, because it has to do with disasters, it hits a part of the brain that we've been programmed, that I'll call it the reptilian brain. It's been programmed to run away from natural disasters, right? So back in the cave days, the cave people that ran away from natural disasters and went to the cave are the ones that survived. And so, like it or not, that's what's in our brains. And so when a hurricane hits and you're seeing it on CNN, that reptilian brain is saying, run away from this thing, right? And so then you might go on your Schwab account and hit redeem on the thing. That is the wrong thing to do for all the reasons that we talked about before, right? If you redeem after an event, you don't get the hard market after that. So that's super important. So investors really need to think, can I overcome the reptilian brain, the bias towards running away from these natural disasters? The second kind of behavioral bias is something that is related to probability, and that we're generally pretty bad at thinking about random things. And I'll give you two examples that relate to hurricane risk. So if you've ever played roulette and you get 3 reds in a row, what is your instinct?
Oh, black's got to be next.
It's got to be next. It's got to be black. You feel like it's called, and there's actually a name for that in psychology. It's called the gambler's fallacy. When even though your frontal lobe is saying that's a 50-50 bet, something inside you is like, we're due for black. Okay, so that's one version, and the exact opposite version. This is a timely example because of March Madness. If you have somebody that just hit 3 3-pointers in a row, you think they're going to hit the 4th. That's called the hot hands fallacy. Those two things are very powerful. And when you are investing in reinsurance, hurricane risk, remember I told you hurricane risk was the biggest risk?
Yeah.
You get that all the time. People are saying, oh, we've had 3 quiet hurricane seasons. We're due for a bad one. Or we've had 2 bad seasons. We're going to have another bad one. Neither one is true. The probabilities reset every single year. Mother Nature has no memory about these things. So the good news on this is that these two behavioral biases keep the tourists away from this asset class. And what that means is the risk premium stays strong. If it got too popular, and you think about this is an uncorrelated asset class that's high yielding, you run the risk that everybody plows into it and then the risk premium goes down. But we have these two things that are a little bit velvet rope around the asset class that are keeping away the people that don't really get it. So if you believe that you are on this side of the velvet rope and that you can stay invested and overcome the run away from the disaster bias and the probability biases, then this is an amazing asset class for you.
Yeah, that's so insightful. It's why you get the premium.
Exactly.
Yeah, that's why you get the premium.
Exactly.
Well, this has been really helpful and interesting. At least I found it interesting, and I'm sure you guys out there listening do as well. But I really appreciate this, Peter. We've covered a lot of ground here, and we're not making any recommendations on the show about any particular product or idea, but I think it's really helpful to be informed, especially as we think about trying to preserve and grow capital or grow income over a long period of time. We may have to think a little differently than we have in the past. So for people that want to learn more about you or Stone Ridge, what's the best way for them to learn more about what you guys are doing in these alternative asset classes or reinsurance in particular?
Sure. So we have a great, super useful website at stoneridgeam.com. That's Stone Ridge Asset Management, stoneridgeam.com. And we also would love to hear from you. If you have any questions or comments, email us at insights@stoneridgeam.com. And as I told you before, Jeff, my title is Chief Education Officer. It's literally my job to educate folks like you all listening to this podcast. And I personally love nothing more than hearing from real investors, because at the end of the day, we exist to help you all achieve better financial security. And if we can hear directly from you, we get that done in as effective a way as possible.
That's fantastic. Well, thank you so much, Peter. I think your title is appropriate because you are a really good educator. So thank you all for joining us today. I hope you found some nuggets of wisdom here that you can use. And if we can help you in any way or have any questions of me, you can reach me at moneyandmeaning@tandemgrowth.com. You can certainly check out our corporate website at tandemgrowth.com if you'd like to learn more about the work that we do. I hope you enjoyed the show. If you'd like to check out past episodes of the Money and Meaning Show, it's available at all your favorite streaming services. I encourage you to give them a listen and give them a rating and share them with your friends. But thanks again for being with us. Hope you enjoyed it and have a great rest of your day. Take care.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.